So on this date, we disposed the entire investment. It could have been that we only sold a portion of the shares. That can happen. It wasn't the case in this example. In this example, the entire investment was disposed of. Now, very important, on the date that you dispose of either a portion or the entire investment, you first have to do a fair value adjustment. This is so that you don't show a profit or loss on sale of an investment that should be at fair value. Now, if your investment should be at fair value and you sell at fair value, how can you make a profit or loss on sale? So we first have to do a fair value adjustment. They told us that the fair value on this date was R3.85 per share. So we need to adjust our current balance, whatever it is, adjust either upwards or downwards to get the investment at 385,000 because we have 100,000 shares. Our investment currently is at 380,000. That means in this case we have an upwards movement. That's why we say debit investment. Where does the movement go? We are in the category at fair value through OCI. The movement goes through OCI. Now, if you had only sold a portion of the investment, not all 100,000 shares, maybe 20,000 shares or 25,000 or 60,000, how many ever. If you didn't sell them all, you would have a choice. You could do this specific journal, the fair value adjustment. You could do that only on the number of shares that you are selling. But this actually makes the calculation of how much of the mark-to-market reserve on equity instruments should be recycled to retained earnings. It makes that calculation harder. Now, in this case, all the shares were sold. You didn't have to decide what to do. But if you only sold a portion of the shares, we would still suggest you do your fair value adjustment on the date of disposal on all the shares you have. It just makes your calculation of the amount that gets recycled a lot easier. So we have done our fair value adjustment. What is the next step? You now de-recognize the investment. The investment is lying at fair value. Take it out. Credit your investment. Take out the investment, de-recognize, and the debit is bank. You sold the shares, you received money for it. Now, in the given information, we were told that the mark-to-market reserve on equity instruments does recycle to retained earnings on the date of disposal of either the entire investment or a portion of the investment. In this case, it was the entire investment. That means we need this third journal where we take the amount that is currently in mark-to-market reserve. So you need to go and calculate what is the total cumulative balance in mark-to-market reserve. You need to go and have a look in that column in the statement of changes in equity. What is currently in there? That entire amount gets recycled, taken out of the mark-to-market reserve on equity instruments, moved to retained earnings. If you only sell a portion of your shares, a portion of the investment, only a portion of the mark-to-market reserve on equity instruments will be recycled to retained earnings. And to calculate that portion, it makes the calculation easier if you fair value adjusted your entire investment on the date that you dispose of a portion of that investment. But in this example, luckily the entire investment was disposed, so the entire mark-to-market reserve, whatever amount is lying in there, will be recycled to retained earnings because that's the accounting policy. We do recycle. If the accounting policy was not to recycle, you would not have this third journal. You would leave whatever is in the mark-to-market reserve right there. even though the underlying asset was sold. This recycling is a direct movement in the statement of changes in equity. You transfer something out of one column in the statement of changes in equity into another column. Now, I have a question for you guys. In this example, we did not say that there were any transaction costs on the disposal of the shares. Now, if this company worked through a broker for this specific share transaction for the disposal, the broker would have charged them a fee and there would have been transaction costs. So there would have been credit back, paid transaction costs. My question to you is, what would be the debit entry? Remember now, initially, day one, when we acquired the shares, we said the transaction costs are not allowed to be an expense. If we are in the category at fair value through OCI, those transaction costs initially on day one need to form part of the initial cost of this investment. Now the question is on date of disposal, if there are transaction costs. You would need to write a journal for that. Credit bank, you pay the costs. What is your debit entry? Is the debit entry debit investment? Is it like the journal we did on initial recognition? Can you debit the investment? Now guys, you have just disposed of the entire investment. You cannot debit the investment with the transaction costs you incur on date of disposal. The investment is derecognized. It is gone. Would it be different if you only disposed of a portion of the investment? Then there is some investment still left. Can you then say debit investment? No, because the transaction costs relate to the shares that were sold. They are no longer part of your investment. They are disposed of. So any transaction cost that you incur on date of disposal, even if you are in the category at fair value through OCI, those transaction costs are an expense. So credit bank, debit transaction costs through profit or loss.